Hello and welcome to the Safi Private Wealth Podcast. I'm Leonora Stevens, a private wealth partner based in Bristol. I'm joined by Mike Hodges, a fellow private wealth partner based in our Manchester office. Hello, Mike.
Hello, Leo.
Join us each episode for in-depth discussions on private wealth matters, from estate planning to trusts and retirement and gifting strategies. We're here to provide practical tips to help grow and protect your wealth. And please don't forget to subscribe on your preferred podcast platform. Today, we're discussing a topic that comes up again and again with our clients, mainly focusing around the use of 3 different structures or investments for family tax planning, whether that's family investment companies versus trusts and offshore bonds. We'll talk about how the 3 options compare and why clients will choose one structure over another. Each of the 3 options have their own tax profile, planning opportunities, and practical advantages. Increasingly, clients are deciding on blending their options rather than just relying upon one. So let's unpack what makes each structure tick. But before we compare them, I thought it would be useful to start with the why. For many wealthy families, the challenge is the same: preserving the wealth, growing it tax efficiently, protecting it from risk, and passing it on effectively. But with the shifting UK tax rules, particularly around non-doms, trusts, and corporate structures, clients are asking more questions, exploring more options, and expecting more flexibility in the solutions that we are considering. So let's start with one of the most traditional structures, trusts. Mike, do you want to summarise what a trust is and what the benefits are?
Yes. Where to begin? I mean, trusts go back hundreds of years, don't they? And some people, I think, hear the word trust and are immediately put off, but don't be. And it's still something I haven't sat down and worked through, but a lot of my clients have no idea what proportion, but it's still very common, still something we talk about on at least a weekly basis, I would suggest, with our client, even if not quite a daily basis. You are separating out ownership and control of an asset. And I suppose that the main 3 reasons you are thinking about a trust is control and protection. So you might want to maintain control of an asset, even if you've passed on the economic, what's called in trust terms, beneficial ownership. So it might be your next generation's children, grandchildren, etc. At the same time, there's a tax angle, which is potentially in around estate planning, because you can put assets into trust up to your nil rate band with no inheritance tax costs. And that's why there's been this scramble we've talked about in previous podcasts around business property relief and agricultural property relief, because that's allowed people to transfer way more than their nil rate band into trust, protected by those reliefs. Because if you don't have that protection, then transfer more than your nil rate band in and you have a 20% lifetime rate of inheritance tax, which is a fairly big disincentive. The trust itself is taxable, so there's all sorts of compliance in the background, tax returns, registration of trusts and all of that. So you're not immediately creating a better tax environment necessarily, although sometimes people look at it in particular for grandchildren and creating income in their hands where you can use their personal allowances and those sorts of things. So that's a sort of a very specific subset. And there's the whole confidentiality succession point. So I know you'll come on and talk about FICs, but trusts aren't a public thing other than the fairly new trust register. So there isn't a Companies House equivalent. So there's more confidentiality there. And on death of the person who sets the trust up, the settlor, it's not an asset passing by through the estate. So there's no delays with wills and probate and that sort of thing. The trust is already set up if you've done a lifetime trust. Equally, some people will have trusts contained in their wills. So there's a potted summary, and I'm not even going to tell you how many years ago, but when I did my degree, there was a paper on trusts and equity. I never understood trusts at a theoretical level, but when you see them in practice, you think, hey. So, I spent a year studying them. We've summarized them in 3 minutes or a minute and a half or something. High-level tax treatment, as I say, they're taxable to income tax, capital gains tax in the normal way in their own right. And it's the highest rates of those taxes, they're typically, so you're not doing those for that saving. Inheritance tax, because as I've alluded to, the assets are no longer in your estate or an individual's estate. There's this whole separate regime that says, right, every 10 years you value the assets in the trust and you apply a rate of tax of up to 6%. And that's meant to mimic the generational charge to inheritance tax on assets held by individuals. And if you take assets out of trust between those 10-year marks, then there's an exit charge. So quite a complicated and involved, really good for exam questions and calculations, all that sort of thing. In practical terms, they are, by the specialist practitioners who operate in this area, really well understood. There's a proper legal framework. As I said, they're suitable for asset protection. So in the right circumstances work really, really well. I've described that there can be no particular tax advantage unless you're looking at estate planning across generations. Reporting, as with everything in this world, gets more onerous, and they can have some inflexibility because there are all sorts of things around perpetuity periods. How long can a trust exist? A company exists forever. A trust has set periods it will last for. So it's not an answer to all problems. It's like everything we're going to talk about. It's got some running costs, some setup costs, and all those sorts of things. As I say, people tend to be or can be a bit put off them because you hear that word and it's not an everyday word. But hey, no, we use them regularly in what we're doing. So
I was just going to say that some people are put off by trust because they don't understand the concept, which I think moves on nicely to what family investment companies are. Family investment companies, or otherwise known as FICs, I suppose that they probably had the biggest growth in the UK private wealth arena over the past 10 to 15 years. So what is a FIC? It's just a standard UK company, and you can have it limited or unlimited, which the impact of that is whether you have to submit accounts to Companies House or you want a bit more anonymity. But it's a vehicle that you can hold and grow your family's wealth. And, the shares can be structured in such a way that you have voting and non-voting classes of shares. You can have alphabet shares, but it's a way of separating the control from the economic benefit. And so why do clients want to look at FICs as an option? Well, one of the key ones is that the companies they suffer tax at a rate of corporation tax of 25%, which is if you held something in your own name, then you would potentially be paying up to 45% tax on that. So that's obviously much lower. Control and governance is another point. So parents can retain the voting shares, for example, whilst the children can have the non-voting shares. So say they can still get the control whilst value is still passed on to the children. Again, you can implement things like growth shares as well, which is another. We could have a whole podcast on growth shares. The growth attributes to above a hurdle would attribute to the growth shareholders, which you ordinarily have as your children. The other benefit is there isn't a 10-year charge, there aren't exit charges. So that's a benefit versus a trust. Although you do have to think about there isn't an exit charge, but there are there are charges on taking funds out of the company. Investment flexibility with a company, they can hold basically anything, property, portfolios, private equity. A lot of people are considering now looking at companies to hold property, for example, especially with the rates of tax on property income going up to 47% from April 27. So that's something that quite a lot of clients are looking at as to whether to incorporate their property businesses. Then looking at, as I say, the tax treatment for a company versus trust or personal. As I said, corporation tax rate is 25%. But one of the benefits is that most dividends received by a company are tax-free. So it depends on the source, but say the majority are. So this enables quite a slick way of growing your funds within the business without suffering any tax. CGT, so companies don't pay CGT, they pay corporation tax on their profits, again at 25%, and IHT. So there isn't really an IHT efficient way of investing in a FIC, I'd say, because it would be deemed as an investment business and therefore unlikely to be a trading business. And so you wouldn't get any of your sort of business property reliefs, even though those have been restricted. But the value of the shares on your death would be within your estate. But you might want to think about gifting shares. A lot of people set up a FIC via a loan into the company. They can gift that loan to their children. They can set up growth shares. So there's lots of things that can be done. And it's definitely worth sitting around the table with your tax advisor and also your lawyer to work out how best to structure it if you are thinking about that. So what are the practical reasons as to why people choose a FIC? Well, there's strong control mechanisms. The structuring can enable the owners to pass future growth onto their children with a mix of the loan funding and growth shares. It's effective for large portfolios. So if you have a large investment portfolio, it works quite well within a corporate. Attractive tax on reinvested returns. There's a professionalised business-like structure. People understand companies. If you set up your own business, you're an entrepreneur, you've sold your business, you've got a load of money, people like that, they understand the corporate structure. And also another point is that you can deduct your investment management and finance costs, which you can't do for personally held investments. But there are limitations. As I alluded to earlier, there is a sort of in effect double taxation on extraction. So to get funds out of the company, excluding the point about whether you've got loans from the director in, you have to pay dividend tax or income tax on a salary. So that needs to be considered. The administration is slightly more complex than the trust. And also HMRC's interest in FICs has arisen in the past, although no major policies that have come in so far. But I think it is something just to be in the back of your mind. Again, a plain vanilla company will probably not get any interest, but where you have all the bells and whistles and it's all very sophisticated and complicated, then that potentially is an area they might think about more. But as I say, for clients focused on the long-term compounding and governance, FICs can be extremely powerful. It's a long-term game. They can be as simple or as complex as you wish, depending on what the clients are trying to achieve. And so that's a sort of, again, a 3-minute or however many minute roundup of FIC. Again, we could cover the whole session on this. Do you want to summarise what offshore bonds are?
Yeah, so offshore bond, we'll try to do this relatively quickly and pain-free. And this is much more in the world of, you've got a lump of value that you want to invest. You sit down with your investment advisor and they will recommend you on bonds. And we should say, I'm sure you'll say at the end in the wrap up there, that we're not giving investment advice and can't give investment advice. But I guess if a trust or a FIC is a personalized, you are the trustee, you are the shareholder or director of your FIC, you control it. This is much more buying the retail product. You're putting a lump sum into what we would call a tax wrapper, and then you're seeing what happens with that is managed externally by external investment advisors. Not that your trust funds or FIC funds can't be invested in a similar way, but for your lump sum, you're effectively buying a deferral. It has a natural life of 20 years because each year you are allowed to withdraw 5% tax-free, because that is treated in UK tax terms as just a return of the money you put in to start with. So you'd say, right, I can put in £1 million and I can have £50,000 a year without even thinking about tax. And within the wrapper itself, that in an offshore bond, there's no tax. It's a roll-up of funds. And then at the end, people would say, well, if by the point you get to that date of the whole thing unwinding, you might be retired and your income level's lower, therefore the return you get on the investment over that 20-year period is taxed at relatively lower rates of tax. And all sorts of, again, complicated calculations around, you get your money back at the end of the 20 years. You can partly encash through that period or fully encash through that period, but there's then a spreading, so it's not a lump taxed on you up to sort of the highest rates of tax. There's some complicated calculations to be done to the money you're getting over the period it's accrued over, and that's what's called a chargeable event. And most of it isn't as horribly complicated as it sounds, because the insurance company or the investor will write to you and say, this is a chargeable event, this is the amount, just put these on your tax return. So in that sense, it doesn't have the personal level of complication and involvement. You've bought a product, so it can have some costs associated with that. And you are not typically choosing your investments. You've just bought something that someone else does. Whereas your FIC or your trust might have more of a family flavor to it. So assets in the family company, those sorts of things. And everything's coming out as income eventually rather than capital. So that can have implications, but there's planning to be done around it. And I've sat in meetings with investment advisors where we have a compare and contrast discussion about the issues. I always feel that there's a slight blurring of the edges, because people say, well, 20 years away, what happens? And because it's income, it can be quite expensive in tax terms, but people are usually happy to say, well, 20 years is a long way away, so we won't worry about it now. So quite simple. There's some tax deferral and you can plan it, and you can pass these assets around between family members, so without triggering a chargeable event. So did you want to do a quick comparison of the three then, Leah? I think that was that you said you would.
Yeah. So if we look at, we've obviously covered off trusts, FICs and offshore bonds. So if we look at trusts, these can be best for people, for clients, best for control, protection and estate planning. There are some tax inefficiencies, but there are strong succession benefits. And they've also been around for many years, so we know how they work. FICs, obviously we do know how corporates work. They can be best for long-term investment growth, control and governance, but they're less suitable if liquidity extraction is the priority, because, as I say, extracting from the companies, it can incur a tax charge. Then we've got offshore bonds. These do tend to be best for the deferral and smoothing of income, especially for trustees or those expecting future lower tax rates. So, for example, on retirement. So no single structure, I'd say, is best, but it really depends entirely on what the client's objectives are. Mike, do you see clients mixing these structures, sort of where they might have a couple of those involved?
Absolutely. So, certainly if you are talking about a family investment company, for example, being the preferred long-term holding vehicle for your family's wealth, then you might well say, well, if I'm planning beyond adult children, I'm looking at grandchildren and future generations, potentially unborn, then you may well say, well, some of the shares, and you reference growth shares, possibly growth shares, would be in a trust. So you'd have trust holding shares in FIC to give some flexibility down the generations in that way. Families aren't fixed, so you don't just say, well, that's the family. You're looking beyond just your adult children potentially. And then the potential for trusts and FICs investing in offshore bonds is absolutely something that can be considered. You would look at, I think instinctively you say FIC. If it's got dividend income, that's fantastic because, as you've said, it's free of tax, and you'd need to do a big compare and contrast and family circumstances and using money. And I did reference, whether this is still valid or not, a paper that I dug out from 12 or so years ago where an investment house had done a comparison of FICs and holding assets personally and offshore bonds, and came to the conclusion in most circumstances the FIC outperforms the other two, holding personally or an investment bond, an offshore bond. But I think that's going to depend massively on your circumstance. So each of these structures is going to be very bespoke depending on what you want to achieve. And you might well say, if you're dealing with sufficient wealth, the answer is not going to be all of your eggs in one basket. So probably a mixture of some personal wealth so that you can see yourself to a financially secure retirement and beyond, and then you make provision out of surplus for family. And that's where the trust and the FIC, more I think than the investment bond, come into play. So you're looking at different things. So it's that inheritance tax probably is the biggest differentiator between the three we've talked about.
And what sort of trends are you seeing amongst your clients when it comes to any of those three options?
Oh, it's FICs are still, they seem to have grabbed the imagination. I don't know why it is. I don't think it's necessarily, well, we're not a salesy type of firm, but people just seem to have got them in their head, and they've reached this level of currency. I don't know whether they're discussed in pubs and golf clubs and goodness knows where. I suspect it's the level of understanding which you've alluded to. People understand companies. I've got a FIC. Do people talk about trusts in the same way? I'm not sure they do. But when they understand some of the benefits that we can talk about depending on their circumstances, then absolutely. Offshore bonds attractive. You're looking at a 20-year play. You can give a lump of money to your investment house of choice, and they can invest it for 20 years. So that takes out some of the volatility around the place, especially as the world as it seems to be at the moment. And offshore bonds also for people looking to come to this country who aren't currently in this country can be attractive. But then they're a very peculiar thing, because if you look at people leaving the UK, the foreign regimes have anything approaching our regime of saying, well, that 5% you got back is a tax nothing, because it's just a return of capital. Absolutely not. That's a very particular way that we tax these things. So if you're looking at being global or moving outside the UK, you might say, well, look, a FIC is understood. In civil law jurisdictions, they'll look at you and say, what's a trust, and have their own way of understanding or not understanding it. So again, lots and lots of different factors that mean every individual needs to look at their circumstances. All three are in play, and other options that we haven't had time to talk about today.
Well, yeah, that's the landscape, isn't it? It's trust, FIC, and offshore bonds. Three quite different structures, but each with a role to play in sort of UK wealth planning. I think that the smartest strategies rarely rely upon just one of those options. It's about understanding the client's objectives, what their time horizon is, and when they need liquidity, governance needs, and how much control they want, and find out just sort of family dynamics and building a combination that works for them.
Yes.
So thank you, Mike, for joining me for this episode of the Private Wealth podcast. At Safri, we work with a wide range of clients, both in the UK and overseas. We advise individuals and families on how best to safeguard, maintain, and enhance their wealth, and on the most appropriate methods of passing on that wealth to the next generation. We also help people comply with the tax laws in the UK, which can be complex. It's important for me to mention that if you're considering any of the topics discussed today, you must always take professional advice based on your own circumstances. If you'd like to find out more about the services we offer at Safri, then please do visit our website at safri.com. And don't forget to subscribe on your preferred podcast platform and leave us a review if you found an episode helpful. Thank you for listening.